the economy, precious metals, and of course the gold to silver ratio. Francis Hunt, the market sniper, goes through it all in this episode of Silver Bullion Television. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Francis Hunt, the market sniper, joins us today. Francis has built the Hunt volatility model, which offers traders a unique and technical approach to trading in all markets. His views on gold, silver, Bitcoin, geopolitics, and more have made him a favorite and sought after guest. And we're delighted to have Francis join us once again today. It's time to saddle up and silver up for Francis Hunt. Francis, welcome back to SBTV. How are you doing?
Thanks for having me back, Patrick. Very well.
Glad to have you back on. I know you're a busy guy. People are highly seeking your word and opinion, and I'm one of them. So welcome back. Last time we spoke, you had said how these are not traditional times, and depending on the side of the fence you are on, maybe things are getting worse, maybe things are getting better. But in your view, and this is not financial advice, where does an investor or a trader look to find value?
It's very hard not to just go straight to your precious metals on a question like that. Let's bear in mind most people are not traders or very active traders if they are traders. So most people are in the investor camp. So investor camp means you buy something and you hold it, or you're not engaged in a market. I see a lot of markets that are not worth being engaged. For example, debt would be a short for me, or non-engagement if you're an investor. Gold is your reserve asset, and it's very, very interesting. And we've also had a little bit of a livening event on silver, on the gold-silver ratio just yesterday. So we are talking after a period where we had the first meaningful pullback on that 100 level on the gold-silver ratio. So silver's suddenly woken up. One swallow does not a full summer make yet, but that's a real awakening of some significance that we should also probably be having a look at. But for me, it's gold. Let me take you to the gold chart straight away. It should be up. Let me know if you're seeing it all right. And this was a pattern we were waiting for it to break out of. So let's just highlight. We're on the gold spot, the daily chart. We mentioned to you last time, it's quite a long time ago that we chatted actually. We said, look, you're going to get up to the 3,000 mark and you're going to have some element of a correction. That transpired. It wasn't that long and wasn't that hard after you ran the 3,000. The 3,000 is that in blue right there, that level. And you can see it didn't dip and stay down very long. And then we had almost a surge move that was really violent. That took us from one moment 2,950, next moment through 3,500. That was super strong. In a matter of about 8 or 9 trading days, you'd gone through 3,500 there. So that was almost a little too strong, and that's natural after big moves, which would be both this move and then the final surge move that you had there, that you would have some element of corrective continuation pattern forming. So we've really just started this move on gold, and I'll show you another chart as to why. But what did we have here? We had a broadening structure, which is with a downward bias to it, and you look for 3 distinct moves in that, and then you expect it to break, and that's kind of what's happened. 1, 2, and then 3, and then you go up and you've broken. So you've broken out on gold. That happened first before the silver surge, by the way. You made a smaller target, and now you're having a little bit of a pullback day. This is actually, if you missed the breakout on gold, a good moment to be getting back in. It's natural after you've broken a key technical event, which we feel that was a capping descending grind line, to get back in, because this has generated as a continuation pattern a whole lot of new targets and a number of them are through the 4,000 mark as part and parcel of the next legs up. So we've got 3.7 there, we've got 4.2. So this is continuation. Those aren't going to happen overnight, but I think you're going to have continued steady upside here from gold on the upside. I'm going to take you also to a bigger time frame chart for those that think, but hang on, gold's done so much. You know, the miners most of them were working on $2,000 gold, and now it's gone as high as 3,500, and surely, you know, that must be a top, and all of this. I need to set people that are in that frame a little bit right. This is the beginning of a far larger move than most people realize, and they're going to sell too soon. People are going to end up snatching profits in an event that actually is a far bigger one than many of them realize. This is the history of gold on a far larger time frame. In fact, I'm going to take you to a quarter, which is 3 months, not 1 month charts, and we'll bring this through, and I'll just show you that. So that's where you were post-Vietnam War was largely coming to end, 71, 74. And that was the Nixon gold standard major event when you were down around there. So what are we looking at? Gold divided by the BLS's CPI. Now, I would argue that we should be using shadow stats as CPI because the BLS is not accurate, but it's the best number that the government departments are giving us. And this has you just breaking out July 24. So each candle is 3 months, a full quarter. Please bear that in mind. So it took the second half of last year for us meaningfully to break out of this red dashed line. We hadn't taken out that high yet. We still haven't. That's the 1980s high. So just to be clear, the 1980s, the $800, you have not met the equivalent of $800 when adjusting on a compounded basis for the inflation rate. So you haven't even met that. And $800 bought you a lot more in those days than it does today. So this is a very early doors breakout. I highlight that this effect of the CPI has given you a very strong ascending. Some people will refer to this as a triangle. We actually have what we call an upside HVF, but this is a very ascending structure. This is because the inflationary aspects were so high that gold never got to adjust nearly as low down as it did in 2001. When we had the lows of just prior to 16, the Shanghai Accord, those were a lot higher up. And then when we had the dip down of post 21's high, 2020-21's high, we around about mid-22, that 3-year going sideways, which actually when you divide by CPI is actually a downward correction, you didn't get very low at all. So now we've really just begun moves, and these are inside the pattern moves. Here, we're going to have an outside the pattern generated move that we see when you divide it by the CPI is going to take you through those levels. So this journey's really just begun. You're only marginally higher, that localized high there and that localized high there, and you're yet to take the 1st of January, the quarter of the 1st of January. This is going to be huge. So do not get shaken out early here. Don't panic snatch a profit because it's the first time you're seeing green in your P&L. This is a much, much bigger move, and you need to keep on keeping on, and there will be periodic corrections like we just had after a surge move quite regularly. So we will be trading inside of our investment long. So we have investment gold, but we'll also be trading inside of that. And it's absolutely natural for us to have these corrections that you are seeing on the daily chart and the subsequent move out of that. So, you know, there's nothing scary about any of this. This is classic continuation pattern and a pullback after a major surge, which came after a much longer trend. So, of course, you squeeze up and then you break. So that's on the gold side. I want to let you come back at me before I take you into the silver and the silver ratio, assuming you want to hear more about that.
Go ahead, because I was going to ask you about that the silver ratio anyway. But I the 3-month candlestick on gold, that's pretty interesting to look at. So thank you for that. But yes, silver to gold ratio.
Yes. So if we pop over to the gold silver ratio, we had warned just. The first run beyond 100 doesn't necessarily mean you can't go higher. And then you had this. This is gold divided by silver at the end of the day. Then you had that. So that was a little bit of an HVF, and you saw you did in fact make a higher high on the gold silver ratio. That was gold again dominating, and silver not so much. So that's the stretching of the bungee cord. You know, the one's the 4x4 climbing the hill, the other's the trailer. And there is some degree of flex. But eventually when the flex is fully extended, the cord is essentially like a pole. It can't stretch anymore, otherwise it snaps. It's at maximum tension, and that's when the trailer starts to catch up with the 4x4 pulling it up the hill. And we've had, we call this an inverted HVF, so that's a real slap in the face for the gold-silver ratio. So that was the first warning. Silver ain't going to be lagging forever. And then we got this structure, and I'll change the color, and we typically see these. It's been very low vol all around the 100, by the way. That's your 100 mark. That's the technical level. And the Chinese, there's a lot of commentary coming out of China because they've also started talking about platinum. They're very aware of relative valuations. So one would imagine that many of them are looking at 100 and saying, well, if it's consistently staying at 100, I'm a seller of gold at 100, 101, 102. And I'm happy to be a buyer of silver rather, and do some substitution or some portfolio, not just buying gold. And some will say, well, the gold price is very expensive because not everybody in China is wealthy but wants to save nonetheless. So they're prodigious savers even if they're not high net worth individuals. So they will be price sensitive. So at that point, you can see a bit more flows going into silver, and it won't take a much. And we actually had a triggering event, a break to the downside. So we could have gone even more. I was expecting the possibility we could have had another surge even higher, because remember, if the debt starts to collapse, I'm not saying this is the top for the gold silver ratio, but it might be, because this is quite a good pattern that is now broken down, and it implies a breakdown below 92. And when we get these first patterns that are in the opposite direction, they often tend to overperform, and it's the beginning of a new trend. So it could be, for the silver widows who've been waiting for a lifetime to be loved, it could in fact be the beginning of something exciting. But just bear in mind, if debt has a major collapse and it becomes central bank accelerated buying or hedge fund or high net worth individuals, you're still, for the reasons of storage and big money, more likely to still get gold get big flows. But there comes a point eventually where that doesn't hold, and there's more mid-size money, and it's looking at the value that silver represents, and that's when silver starts to dominate. So we could be at a threshold here. So our expectation is you're going to drop as an HVF trader below 92, which could be the beginning of a way down. Just to be clear on that, we want to remind everybody this is a 4-hourly chart. I want to remind everybody more of where we were on this before. We were, because it's quite an important point, we were always waiting for real signs of 75 and 65 to be broken to really start the big move. And we were saying, will that moment come? Will that moment come? And then we had this structure. And when we had this structure, we were getting resisted a lot at 90, this dotted orange line. Every time we got to 90, gold, silver down, gold, silver down. And it looked like we were going to get a breakout and silver was going to be a run. It got reversed. It got reversed back in, and then we squeezed into this. And when we broke out of this continuation pattern here, this top line, we said, actually, it looks like gold-silver ratio is going to go higher first. So we need more drama, more pain, more focus on the debt. And that's exactly what happened. And we broke out to the upside and made 100 again. But this time now we could be reversing. But you could have a reversal to the 90, and then you could have a real contagion event, and you could go back up again. I still think the scale of the crisis is going to be far larger even than CV19, which could by definition mean really big money exiting treasuries at a massive rate, could spike the gold price immensely. Eventually, that gets taken back by silver overperformance. But you can't rule out, even though that we look like we've got a downside target to around the 90s level, that what was resistance, I've made a lot of lines here now, so it's looking messy, that was resistance for a long time could become a bit of support for a while as well. So you could smash it down here, but then everybody's getting heavily long silver and then end up hurry up and wait again, and you could get a bottom here and then you could go back to the 100 again. So be careful always about calling reversals. Generally, there's continuation. Eventually, it is coming, and this may well be it, but there's also plenty scope for false dawns. We thought this was the beginning of the silver downside run. Then we got that huge hammer, and the whole thing just got put back into range. So you can get a lot of false breakouts, and people are so wanting it. I feel the tendency for everyone to want to be that guy that calls the beginning of the silver dominance stage is a little too high. And what tends to happen when there's too many people in that space and manifesting that, they're the small money and the small medium-sized money, and we chase into silver and we don't move the needle as much by stacking our silver than the big money chasing into gold. Even though gold is a far larger market cap, the scale of debt, you're talking, people can't put a number to it, but it's somewhere between 350 to 400 plus trillion, not including derivatives. The scale that has to come out and the degree that the US debt has to down value. Don't forget, US debt markets fell 50% from our top call at 2020 September. That's how much it's corrected. And now, during this period where it's been bouncing along there and not falling any lower, the dollar has been weakening. So you've actually taken a weakening on the debt directly in terms of its valuations with those rate hikes, and subsequently you've taken a weakening on the currency, which is the measurement of the value of that debt. So in both ways, the debt is being deflated. And it is a debt-based collapse that needs deflating, and you're already into that process. And now you have JP Morgan coming out telling you, establishing alibi, as I like to say, so that they've told you so, and also saying they'll be fine. So not only there's going to be a credit-based event, that way they can say, hey, we warned you. They're inside the bank. They know how bad the bank lending books must be. They know if you mark-to-market property, if you looked at credit cards, auto loans, housing, and the masses of homes that have come onto the market right now, and the potential unemployment that is brewing, that you're going to have a heck of a bath on your book, plus how much those bonds have devalued, what that means for bank collateral. The one discussion that is not happening is American banks' solvency. This should be way all over the place. Their loan books are wrecked. Their collateral in terms of treasuries is wrecked. Bank of America bought 500 billion as part of their collateral at around 1%, yielding 1%. It's not yielding 1% anymore. So, the banks are done and wrecked. And JP Morgan also says, don't worry, we'll be fine. What he's actually telling you is they are positioning to, having made the money on the upside of this liquidity surge, to short it all the way back down and to say, hey, we're a trading company. We saw it was compromised. That's what we do. So in the fire and the ashes that every American will be feeling in the reduced cost of quality of life and increased cost of living, they'll need to know that their banker friends that originated the whole crisis profited it on the way up and the way down. And they're trying to establish alibi with, hey, what could we do? The trade was there. We just took it. We just innocent bystanders standing on the hill here and spotting an opportunity. No, they orchestrated this. It's a demolition of intent, and they profited from the upside and from the downside. And you are who they traded against, and you will feel it in the loss of buying power in your currency and everything else. And the only way you protect yourself from that is you own gold. And they're still going to come after you for that. Unrealized capital gains, they're going to want you to tokenize it on the blockchain and all other forms of Palantir and other database development, tertiary extraction, capital extraction, social scores, all sorts of meanness is waiting you around the corner. So there's quite a lot for you to unpack there as well. So I'll let you have that one back.
Yeah, I'll get a few quick jabs in here. Say I'm moving into the precious metal space. Um, You mentioned there may be some people who should be considering perhaps selling gold for silver, but not advice there. But besides that, if I'm just
Not
coming
yet.
into okay, not yet. Good point. If I'm just coming into the space and I have the four metals, gold, silver, platinum, palladium, how much would I possibly want to allocate toward each metal?
I think, whilst a very interesting question and one we can't help ourselves from asking, we all want to pick the winner. The real story in all of this is making sure you have proper precious metals exposure. And actually, if you're 100% gold and have $100,000 in there, you're so much better than somebody off than having 20,000, 5,000 in platinum, 5,000 in silver, 5,000 in palladium, and 5,000 in gold. Get as much as you can into the general precious metal space, with gold being foundational. I would say gold should be your domination by foundational value, because it's also about tradability and sellability. I love platinum right now. I brought up this chart right now, but let me tell you, it's a thinner market if you have a kilo of platinum to sell than you do a kilo of gold. And you do eventually want to sell. I'm not a perma bull forever and infinity. We will overshoot on the precious metals hold, just like everything else. The markets will keep going until people can't believe it. They can't afford not to be in it. Even people who hated gold feel stupid around the barbecue. Everyone around it has got it and has made 30% in the last 4 months, etc., etc. You've got to have that dot-commy moment. And that's when you might be wanting to turn it into agricultural land, buying a new home. The property prices will have collapsed. The rates would have spiked. Debt contagion is falling in on itself. All sorts of things are going on. So if you just look at this since 2000, what is this chart? It looks a busy chart, so I'll explain it. This is since 2005 to today. So it's 20-year chart of the four metals. So your question was, I've got 100K, how do I align it? And I would actually still say I would be anywhere from 80% and maybe higher even on gold. Just keeping it simple because of tradability and liquidity. It's the most common and it's the most established monetary reserve asset. Palladium, platinum. I've even got rhodium on this chart, by the way. Incredibly unique and small market. But platinum, in terms of the last 20 years, is the most hammered on the downside and is actually rarer than gold. So could platinum outperform and become more valued than gold? I spent my whole youth as a guy who was platinum was gold plus 30% typically. Throughout my childhood in South Africa, we pulled both gold and platinum out the ground, and we remained between 60 and 70% the biggest provider of platinum in the world. It's not the bastion of stability. They had power issues on mines there. And Russia, who everybody's must make war against, it seems, is, I think, deep into the teens for the rest. So the rest of the world, every other nation, is incredibly small on the platinum front. And I will highlight Zelensky with his front men behind him, or his money men, invested 51% in South Africa. He showed up in South Africa, a deeply not covered event, only because I have connections and I see the news in South Africa, even though I'm not there, and purchased 51% controlling stake. Wonder where he got that money from his warmonger billionaires that are backing him in North Platts, Northern Platinum, which is a big play. I've known North Platts as a listed miner in South Africa for an extended period. So he is now a majority controlling shareholder, highly significant in one foul swoop of a transaction. And Cyril Ramaphosa, facilitated this or was around to welcome him, and this investment took place. So that's also a signal platinum is going to be a ripper and a runner, in my opinion. And XPT, that's where it is. It's 19.5% off the 2021 precious metal highs, which saw palladium, the gray line, deeply eat all of platinum's dinner there. So that was palladium. But then, and rhodium did something similar, the black line. So those two have corrected violently. Gold is the monetary asset, and this is a monetary phenomenon. Again, why I say you should not get too sexy or clever. 75 to 80% in the gold, it's a monetary collapse. It's a debt-based collapse that is a monetary phenomenon. The most monetized metal is gold. I know it's not as cool to say, well, I've got palladium. Palladium as a performer is second, but silver is catching it. And I did this chart before the price action of yesterday. So I would imagine silver is going to take palladium. Palladium, big industrial uses, the whole green agenda, but it's now very much on the wrong side of trend now, and ate a lot of platinum's dinner. There was substitution. Platinum was for diesel engines, and that was the wrong thing. So platinum was underperforming throughout this period when we had the 2011 bull highs. You can see palladium, the gray line. So you've actually got, from about 2009, they came off very badly. So I've highlighted the stages. The platinum group of metals, which is palladium and platinum, underperformed generally after the 2008 kind of semi-high they had there. They sold off really badly into 2009. So since 2008, platinum's been an underperformer. Then palladium started to outperform platinum, and it kept platinum failing to make new highs and in a continual down leg, down, whilst palladium was going higher. Gold really started, it's kind of based in 2019 after the 2011 high, and started its move. It then had the 3 years sideways, and then really started its move here in 22. So gold is getting the one with the current momentum, and silver is part following it. Not 100% so far, but part following it. So palladium is still being corrective. So I wouldn't be buying palladium now. And I also wouldn't be rhodium. There's an ETF, but it's very hard to get. So it's almost a wild card in here. Platinum is the cheapest currently, is 52.9% of its all-time high that was way back in 2008. So it's been deeply unloved. The others, I would let them base a bit because they've got very specific industrial use case, palladium and rhodium. So if that's the whole case, I haven't got copper on here. That's a bit semi-precious. It's a bit more unique. So gold, 75, 80%. I would be tempted to put the other 15% in silver. By the way, once we get a clear, and we've got a warning, a possible, but if we have a real reversal and we break the 75 gold-silver ratio to the downside, everything I'm adding thereafter will be 100% silver. So I'd rather overweight gold, stay with the first stage of the movement. Might sound too conservative for some. Many people just started stacking with silver a long time ago. They've sat out the gold bull market to quite a large degree, it has to be said. You know, the middle of the 30s, 34, okay, we're back there again. But the sad fact is gold's gone from, 1800, 1900 to 3,500. That's a much bigger move than silver's done so far. So this has broadened. So you still want all of these. Gold is at an all-time high at the 3.5. It's pulled back obviously recently. Silver is 30.7% off its all-time high of 2011, which was $49. Now, the 1980, when it hit 48 and some change, so which is technically marginally lower, was actually a much bigger high because of inflation. Again, that $48 of 1980, 81 was a much higher number than the 2011 high. But the nominal high is 2011 at 49, and it's still 30.7% off. But when it gets going, it's going to go. It'll go 3x, 5x sometimes on gold at that point. So have the other 15 to 20%. And if you want to play with a small amount, and especially for Europeans or British or people where you pay VAT, I would almost leave platinum out or have no more than 5%. In the US, you can buy North America, I think, I'm not too sure about Canada, without taxes. So because of the industrial element for platinum, it gets a VAT of 20% depending on your country in Germany, Europe, etc. So that's just paying a tax to buy the metal. So again, that reduces my appetite for platinum because you just get plus 20. That's like a super big spread, and it's also not as liquid. So if you're in America, fine, you can have 75% gold, you can go 15% silver, or you can be 70% and 20%, and then you can play 10% on platinum because you're not paying an additional tax to get in. Then you'll have it as a sort of, call it a super runner to give you some alpha. Because I do think platinum could go higher and faster. It's a much thinner market, just so that you can see, palladium went like that. It's a thin market. Rhodium went from lows down here. It was an absolute screamer up. So you could have out of platinum a kind of version, maybe not quite as large, but that will definitely dominate gold, outperform gold. But you should have that base yellow metal easily tradable in that. Coins as well as bars, not just bars, because you might get some numismatic benefits if they bring in any capital gains taxes, and selling, recognition, and various other things. So it's not only bars, which tends to give you the most metal per ounce. You should have a mix. And with the silver, definitely the same, because you might have some transactional benefit with the coin. So there's quite a bit on your question regarding the other metals there.
Something came up though. You mentioned platinum. South Africa, a lot of platinum. Russia, a lot of platinum. Two countries that are in the BRICS. Two key countries in the BRICS. Why do you think they were looking at a gold-backed currency instead of perhaps a platinum-backed currency? Is platinum too small?
Well, too small is always fixed by price.
True.
But it seems the yellow metal for millennia seems to have been the one that's captivated people most. And that means it's the most monetized by tradition. There might be other, gematria, shamanistic, and other values. It is one of, I think silver's the best conductor. I'm not sure if it's better than gold. I think it is, but it might not. I need correcting. Someone in the audience will leave a comment. But I know in the McLaren F1 sports car, they chose to use rolled gold for heat dissipation because it's their most efficient metal for that, which could mean maybe in conduction, electrical conduction, but it's just too expensive. So there are certain properties that make certain things just best, number one, at doing something. Silver has therapeutic, you sleep with silver threaded sheets. Tour de France people that have injuries typically have these sleeping bags of silver thread, colloidal silver for medicinal and antibacterial. There is real quality to these metals that goes beyond perceived monetary value. They are good. I would love to have enough silver to actually have a bed frame made out of it without a headboard and just sleep on a block of silver, essentially, with a mattress, of course, and those same Tour de France sheets all threaded in. But I do think you'll probably find, in terms of your energy and currents and things, that we get into topics that are a lot more esoteric, but I wouldn't shock me to see it's a very grounding and very probably anti-inflammatory in many, many ways, just being in contact and around. And that's why kings and queens draped themselves in it. There's potentially a subconscious intelligence in there. So, I'm not the best man to answer topics of that nature as a chartist, but I would hazard a guess that there's esoteric reasons, and quite probably based on instinctive intelligence that science is yet to prove, and some ones that maybe it has already.
Well, I have a question a chartist could definitely answer here. You brought up the dollar. Wanted to ask you regarding the US dollar. Year to date, it's moved from a little over 110 on the DXY to a little over 98 currently. This is almost, I believe, about a 9% drop year to date. What's your take on this?
Yes, this is an interesting one. I brought up the United States 30-year government bond here, and this is the rates, the yield. Then I've got the gold chart under it, and in actual fact, before I'm going to take that out and put let's just say the Dixie, and I want everyone to remember that the dollar index is not a good benchmark. Really, it's very overweight euro. It's about 52% euro. and then small amount of pound, Japanese yen, Swiss franc, and a little bit of Swedish krona as well thrown in, all in small bits. But what you can see is there was a major dislocation. We had rates climb, and then you had the dollar climb. Okay, that's fine. That's what should happen. The key moment was this event right here, when we went peak Trump tariff tantrum. And what happened there, and it's almost worth changing color, is that rates went up. You were 1 minute there and it closed there. Rates shot up, which was a real concern about US debt, and we are trading higher today, even though it's calmed down. And what actually happened, this was literally the beginning of April, you can see it. I haven't got it perfectly, each chart perfectly under each other. Let me get it there. Is that you had a dislocation. As I've shown you, when rates go up, dollars should go up in value because you're paying a higher yield to hold dollars. What actually happened is people were divesting from America, and the dollar went down in that opening period. And in fact, you hit a low down here. So what actually happened is you had a breaking of the relationship of higher rates, higher dollar. That pointed to a loss of confidence and faith in the United States when Trump was throwing his weight around. And the bond market started to go up rates, down value, and instead of the dollar going up with it, you got the dollar going down. And the dollar hasn't recovered really from that low. It's still very close to lows, and the yields are still close to highs on a typical long bond instrument, which is the 30-year weekly instrument. So I'm comparing these two charts underneath each other, and I'm saying this was a pivotal event. We said this moment would come on your show when we spoke about Liz Truss and Kwasi Kwarteng in September 22, when they did a stimulus budget that would have led to more debt creation. They had a pension crisis that led to the currency going down and the yields going up on UK debt. And I said, it's a small, far more insignificant country nowadays. I'm sad to say the British. But that moment comes for America. It will be far more significant as a hegemon and a far larger nation. You had that moment. You had it here. And anyone who thinks it's recovered, it hasn't. It's not recovered until the yields go back down to where they were here when that happened, without the dollar going further down, or the dollar goes back up to where it was when it happened without the yields going any higher, or any mix of that version. But right now, what you got is dollar asset debasement, because the treasury got smaller by valuation at the same time that you were getting a doubler. The benchmark that you measure the value of that treasury, the dollar, debased as well. So that's how they are shrinking this Ponzi. And they need more of that, not less of it, to crush the scale and size of the debt that they've created, which means more dollar devaluation and at the same time, not any great appreciation in the debt markets. And then if they have the dollar steady, they need debt debasement. But one of the valves, it's a 2-valve geyser that's being heated up to explode. They actually need, ideally, both taps to be open, the debt to be devaluing and the currency to help with that devaluation, so that they can slip down this pole of super high value debt. And that's what Volcker did. He raised rates, and the dollar wasn't omnipotent all the time during that phase. And it was a very crushing effect on people's living standards from 68 to 82. And the stock market went sideways and largely down. Most risk on assets, property markets were dull. People didn't have disposable income. It was a pretty poor time. That's because you overborrowed in the Vietnam War and you overspent. And people called bluff and they took the gold. And that led to the gold bull market. This is far greater by scale than that event. And gold ran from the late 60s all the way into 1980. So you had a decade-long, clear-cut bull market. And I'm here to tell you that you're going to need to be prepared to hold your gold for longer than a decade at least before this is done, or it gets so disorderly, which will also likely happen in some of those years, that entire decades of growth happen in months. So either way, it's going to be an exciting time for upside in gold holders and precious metal holders, silver too, which will be a turbocharge once that ratio spins. However, the way of the world will not be a nice place, especially if you live in America, because when hegemons collapse, the downgrade in living standard is huge. We had the friendliest handing over of the baton post-war from the UK to America. And let me tell you, there was 3 decades of the sick man of Europe and austerity in Britain.
Francis, tell me something though. Last question here: if the dollar continues to slide, let's just say it continues to become unloved, unwanted, is it going to be monetary policy that continues to slide, or is it going to be a fiscal policy that is going to continue to slide for the dollar?
So the big beautiful bill is a fiscal spend, and it's an overspend. So any notion of restraint on expenditure and saying we're not going to, this is a controlled demolition. There's no way in hell anyone with a macroeconomic understanding passes that bill at all with the state of events right now. It's kind of like you having a family meeting with the wife and your eldest son who's a teenager and the rest of the kids are just sitting around the table, and you're explaining that you're deeply indebted, you might have to sell the house, you need to do all of that, and you go, let's go on a 5-star hotel to Disneyland for 3 weeks, and let's fly first class and have the party of our lives. That just doesn't work towards solving the family economic crisis. That's the equivalent of the big beautiful bill in terms of the commitment to the military industrial complex. You are doubling down, to hell with it, we're going bust, let's have a last whirl. That's basically it. And expenditure on the military industrial complex is the most typical mediated way for the insiders to steal from you. So they're definitely crashing the plane. They're going to jump out with the parachutes and leave you on board, but they want to finish taking all the jewelry out of everybody on the plane. And the military industrial war is the stripper of assets, the perfect, with all the intermediaries. The greatest hyenas of the world are the arms dealers and the corporations and all the backhanders with politicians. This is so well established, the secret accounts, all of that. So it is a transfer of wealth of the citizens directly to the political figures and their handlers and the war machine that stands behind it. That is the simplest, biggest, longest standing corruptive route, long before the pharmaceutical industrial complex, long before all the other manners that they steal from you and also achieve other population reduction goals. Don't forget, they're going to jump out the planes with parachutes and leave you in it, having put it in a 90-degree dive into the base of the mountain. So fiscally, they're continuing to be irresponsible, and then there it's quite clear that actions speak louder than words. All that Elon bouncing around on the stage and all of that cuts and doggy and all of that, that was a bit of fluff and mood music for a bit of a post-election high. You don't vote yourself freedom. It's amazing to me how many American analysts are going, stick with a plan, Trump's our guy. It's like I just want to, I feel like getting a revolver and shooting myself. I feel my IQ drop 15 points every time I see that. I mean, the absolute stupidity of that, and the handing over money to Israel, the hiring of Palantir that is intricately involved with WhatsApp, the pagers, bombs, you name it, locating Palestinians for extermination, all of that. I mean, don't even go there with me. But fiscally, no sense, and monetary, they have no room to move. Monetary is trapped in a fence. There's no way he can truly cut because they're already having to spend money. The Fed is already buying to support the debt market at the moment, actively. So they're already monetizing. So it's not holding up at its current levels. Remember, bond price value up, rates down. If you want to cut, you're actually saying, hey, those pink Crocs you didn't want to buy at $10, how about I offer them to you for $80? Well, you're going to go, that's a double no, thank you very much, sir. So that's where you are on the debt bond markets. So if you talk about cuts, you're saying bonds are worth more. Every time you say rate cuts, it's got nothing to do with the state of the the economy. Everyone's wrecked. Everyone's books are blowing up, can't pay their credit cards. We get that. But the point of the matter is the funding mechanism for cuts is the bond market. So you're saying loads of money wants to be in the bond market. No, because then the Fed wouldn't be one of the biggest buyers. So the monetary policy is entirely trapped. In fact, the only thing they should be doing, or that the market will probably tolerate, is putting up rates, contrary to everybody's expectations. They need a Volcker cycle of devaluation, of chronic overspend, and to devalue that debt, which means all people that are exposed to credit, especially variable rates, will no longer be able to afford their assets. It's a housing market crash, which we've been calling for a long time. It literally followed our debt turn of 40 years. We said that's coming now after the CV19 events in September 20. We said first the debt market goes down, then the housing market will go down, and in contagion there's lags, and that's exactly 40 years up. We said 4 to 5 years on the elevator down, 40 years on the escalator up, and we're in the, we're getting to the 5th year point, and the housing market, chronic amount of oversales. So it's happening, and it's happening in slow motion right now. Loss of value, and that's going to devastate. It's going to leave people with negative equity, all forms of destruction it's going to reap. And then you get the unemployment, because the consumer stops spending, because he's got no more access to credit in America, and they rely on it intrinsically. And that leads to layoffs. So then you start to have unemployed people. That leads to unemployment payments by government just when they least need to have a drain on resources. So now they're going to have to start paying welfare to unemployed people who've been laid off, that are job hunting for much lower quality jobs with much lower wages. And there's 5 of them competing for every one, to be the dustbin boy. So that's a horrendous doom loop. And the thing is, it self-feeds on itself. Only now, and everybody will go, well, they'll just print, and printer goes, brr. You can't print if there's the reason they could do CV19 7 trillion print is they scared the bejesus out of the entire world, that everyone ran out of the assets they held to buy bonds, which was still considered a risk-free asset. So the stock market fell, all the people selling put the money in the money markets and the bond markets. The Bitcoin fell from 14,000 to 4,000. All those people, all the liquidity got drained and put into the bond markets. So that put a huge bid. So you could issue more bonds because you had the sudden demand surge. There is no demand surge for pink Crocs right now. Nobody wants them at $5, not $1. If you gave them 3 pairs, they would try to get rid of them. And if you sent them a container full of them, they would pay you to take them away. That's where we're at in terms of this overly proliferated, outdated, highly devalued product, debt. That's it. So no bank wants to originate new versions of debt, not on a car as security, because it's reliant on it having a value. If no one can afford to buy it, it sits in a hangar and collects dust and becomes outdated. Then the battery goes, all sorts of things. It requires security to protect. It's an unusable current asset that's on a devaluation cycle. Student loan, all of this. That's where we're at. We're in a debt doom loop where there is no demand for debt as an asset class anymore. The pensions are all bust because they bought too much debt. They need some high risk beta. They need something like gold to fix their pension pots. That is where we are. It's a horrific doom loop, and it's an end of cycle. And I don't say this just to be, he's such a drama guy. He just wants to throw out the black pill and doomer. No, we didn't say that in 1980. We said we're going to have globalization is going to lead to low inflation. I got into a property business and bought property extensively during that period. Why? Because interest rates were being kept artificially low. Everything got made offshore nowadays. The costs were dropping. You had the 6 months of daylight. You moved to the North Pole and you had 6 months of partying and daylight. And now you're feeling depressed because the sun is going and it's disappearing for 6 months. That's how it works. Night follows day. And you went for the longest day and now you get the longest night. 6 months worth of it. It's called an economic depression. That's how severe this situation is, Patrick. Not for headline's sake, not to be the biggest doomer. That's how strong gold will move, though. As hard as we go down on debt devaluation, the relative value in fast losing currency absolutely goes parabola, and people haven't even seen it yet. That's why I say don't sell your gold too soon. The scale of the re-rating and the down valuation is so huge.
All right. Yes, absolutely. Don't sell your gold too soon. And in fact, even news from Asia a couple of weeks ago, where the Philippines, just to touch on with what you're saying, Philippine Central Bank a couple of weeks back said it may consider reducing its holdings of U.S. Treasuries, the debt as reserves. I would assume certainly there are going to be another central bank looking to move into more gold as well.
Exactly. Why, when it's become an open secret that this asset class has to be chronically devalued over an extended period to be worth a whole bunch less, would you want to be a new buyer? And that in relative terms, there's an alternative that's going to go disproportionately up as this thing goes down, because more and more people are going to realize what you already know. So it's the biggest open secret in the financial markets, and you still get to do it. I use the analogy. Your house is already on fire. The arsonists already came and poured it, and you can still buy online insurance up in your office on the second store. And your ground floor is still going down. No one will check and they'll insure it. Do you insure it for 5%, 50%, or 250%? I know which one I'm doing. I go big, and you get paid out. That's where we are, because the building is burning. You know, the contagion is not far away now.
Yeah, amen to all of that. Francis Hunt, this has really been an insightful and interesting chat as always. Please do tell the good people out there how they can follow you on social media and about your courses at the Market Sniper and such.
Yes, so what do? Well, essentially, this is reset times. We want to build wealth, and there will be immense opportunities, of which going long gold is one of them. There will be other things worth. We haven't spoken of my mines and mining and some of the other detail on silver mines, lots of other things that will be going up, and there will be long-term things that will be chronically devaluing. So this is a unique opportunity to build wealth. You can actually set yourself up for the rest of your life, because, as I've already mentioned, there's years when nothing happened, decades where weeks happened, and then there's weeks where decades happen. And we're in that accelerated, quickening convexity part of collapse, where that which collapses fast, and the alternatives go up very, very quickly. So A, build wealth. B, preserve your capital, because governments are the enemy and they're going into peak scavenge mode. So our community is focused on helping people preserve the money they already have made and will still make, utilizing structure, and then secure optionality, point number 3, to ensure you have freedoms of movement, freedom to spend how you wish, and that also gives you option of existence, lifestyle, outside of what's particularly a collapsing West. And most of our audience is Western, and you really do need more optionality in it. That's what our community is about. We give a lot of free trades and potential ideas away on our Market Sniper, the Market Sniper YouTube, also under X by the same name, the Market Sniper. And we cover the Crypto Sniper, covers the crypto space where the new system is going to come out of. No, we don't love it, but it's going to happen whether we like it or not. Apple did not go up because I refused to buy its shares. Neither did Microsoft. They went anyway. You've got to be pragmatic in these times. We aim to help you build wealth, secure and shore that wealth up so it's not easily taxed or confiscated, and secure you greater freedoms. And that's what our channel is all about.
All right, Francis Hunt, I want to thank you again. And I do hope we can do this again soon. And then let's hope for the best coming up in the second half of 2025.
It'll be a good one for precious metal bulls, is my suspicion.
All right, Francis Hunt, again, I want to thank you and wish you all the best.
Thanks for having me on, Patrick. Have a great day.
That was Francis Hunt sharing his views on the economy, the markets, and precious metals. To see more of Francis's work, go to www.themarketsniper.com. If you like this video, please do give it a thumbs up, subscribe, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.